Time for the word on Wall Street. Top investors watching your money. Joining me right now is Markowski Investments President Chris Markowski, Laffer Tengler Investments CEO and Chief Investment Officer Nancy Tengler. Great to see you guys this morning. Thank you for being with us as we zero in on investing. Big week for tech, Chris. We are watching now Meta platforms, of course, the parent of Facebook. They will report after the close, but Google really set a nice tone here, posting better than expected earnings and revenue, announcing a 20-for-1 stock split. We are watching for that. What are your expectations for Meta? And then, of course, we get Amazon tomorrow after the close.
Well, with Google, I think the only when we look at Google right now, it's almost the only thing that can stop it. It's government. And the regulators in Europe and the United States, I know Klaubacher and Grassley have got a bill out there, and Amazon and Google have been spending some money in regards to lobbying. But what I think really Google should do moving forward is do what Apple did 10 years ago and start paying a dividend. They start doing that, and more people start putting it into their portfolios and making it more of a cornerstone for retirement plans. I think it might get some of the politicians off their back, and I think maybe even Meta and some of these other companies might think they should do the same thing and follow suit.
Yeah, isn't that interesting that you're talking about big tech paying a dividend and being there for those seniors who need the safety? And look at what happened to AT&T. AT&T has long been that very thing for seniors. It's cutting its dividend by nearly half after announcing plans to spin off the Warner Media division in a $43 billion media merger with Discovery. AT&T, one of the leading dividend payers in the S&P 500, Chris, and now they say even though we're cutting the dividend, we're still going to be one of the leading dividend payers. Would you still buy AT&T for the dividend after they're cutting it?
Well, whenever you see a dividend start going up 8.5%, 9%, I think that's what it was before. It's right around 8.5% at this point in time.
8.5%.
You have to be a little bit cautious there. I mean, things getting a little bit out of control, even though the P is very low. AT&T just it's comedy of errors when it comes to its ventures into trying to get involved in big media, kind of like the same thing what Verizon did when they decided to buy Yahoo. So I'm glad they're divesting of this. I think they're going to be spending their money right now. They're saving on the dividend to pay down debt, and hopefully down the road they'll be able to raise that dividend again.
All right. Well, we are also going to be looking at the automakers, by the way, this week. GM reporting earnings, and we got Ford tomorrow. Nancy, there were 10.9 million job openings in December. We're waiting on the private sector read when we get the January ADP report. It'll be out in 1 hour's time. But we're expecting 207,000 jobs added to the economy. That's far below the month before when we saw 807,000 jobs added. That was in December. We'll also look ahead to the Friday January jobs report, Nancy. Economists are looking for 150,000 jobs added last month. Unemployment rate holding steady at 3.9%. But what's your take on this big come down from the December numbers all the way down to around 200,000 jobs from 800,000 in the ADP report?
Yeah, well, Maria, I think some of it is seasonal, and some of it is just a slowdown in the economy, which we have been talking about for 9 months. It's the math. I mean, when you grow at the rate we were growing at last year from a GDP and corporate earnings standpoint, you would expect for things to slow down somewhat. I think what was most disappointing in the JOLTS report is services and accommodation. That continues to be an area where companies are having a hard time filling positions. And we've translated that into our portfolios to look at companies that can produce the maximum amount of revenues and earnings with the fewest number of employees, i.e. productivity. And that has led us to one of our favorite sectors, as you know, which is technology, and counterintuitively, energy. So I think that's one way investors can sort of protect themselves from the labor shortage. But my colleague and mentor, Dr. Laffer, recently, I think he was on with you when he was talking about cutting the payroll tax to incent people to go back to work. We've been paying people not to work a pretty handsome salary not to work via unemployment for the last 2 years. We need to encourage people to get back to work, and that's one way to do it, is to increase their take-home pay, which is particularly important in this high inflationary environment where wages have not necessarily kept up with inflation.
Well, that's right, because, Nancy, even though people's wages have gone up, inflation has been zapping it. You mentioned tech and you mentioned energy. These are the sectors that you want to own right now, Nancy. What do you think about valuations within tech? We had that big sell-off at the start of the year. Have valuations come down enough, in your view, as creating entry points?
Yes, Maria, because the multiple for the sector is exacerbated by some of these growth at any price stocks. But to Chris's earlier point, I mean, we own Google. I'd love to see them pay a dividend. But the 20-for-1 stock split is a nice tee up for being added to an index like the Dow, for example. However, it's trading. They grew earnings at something like 36%, revenues at 32, and the multiples just in the high 20s, just above. I think it's around 26% on estimated earnings. Microsoft blew the numbers out, super strong growth, not paying a horrendous amount when you consider that real interest rates, despite what the Fed may do in the next year, are still negative.
Yeah, that's a great point. Yeah, I mean, Google is getting a little higher valuation this morning, certainly with a 10% rally. AMD also strong this morning, Advanced Micro Devices. I always zero in on these chip companies because of the chip shortage. Great analysis, both of you. Chris Markowski, come back soon. Thanks for joining us this morning. Nancy, you're sticking with us all morning, and we're happy about that. Thank you so much. Great word on Wall Street, guys.